If we take a look at the historical basis of the volatility of Disney, you can see that it's currently the last is 23.44. Is that in the lower end of the range, the higher end of the range, or in the middle? I would say it's probably close to the middle of the range. It's not exactly on the high end, and it's not on the low end, that's for sure. So what I'm going to do is I'm going to come back here, and I'm just going to put in mid. And I'll tell you exactly how we use that as we go along. Now, in order to determine the range index, the cost index, and the profit index, all we have to do is highlight these cells and then bring these down and highlight them all. Go to Edit, Fill, Down. And that automatically includes the formulas that we had previously on our issues and brings them right down and fills them in for us. Let's not take a look at these just for a second to do our analysis. Let's do another issue. Let's go to CCU. And we'll take a look at the historical volatility. The historical volatility for clear channel communications looks like it's pretty much on the low end of the range. It's very extremely low actually for this issue. So we'll fill that in first since we're already at that chart, and we'll just say low. Now let's go back and get our straddle price. The last trade was 35.88, so more than likely the at the money straddle is going to be the 35. And we're buying 10 contracts. Just for sake of analysis, let's go to the 37.50 and see if it's a different price. This is $1, that's $1.70. So it looks like the $35 straddle is going to be the cheapest. Let's analyze that as a duplicate trade. And if we take a look here, we have a range here, 20 days to expiration, between $34.20 and $37.67. So let's go ahead and subtract those numbers. Minus 34.20, that gives us a range of $3.47. We'll bring up our worksheet here. The straddle price was $1. The range probability was 347. The current stock price is 35.88. And the implied volatility is at 14.6%. So that's, if we calculate that in terms of decimal places, it's 0.1466. And then all we have to do is highlight these cells, bring them down, and we can fill down to fill in our values. Okay, let's do one more issue here. That's Broadcom. This time we'll go directly to our trade tab. Enter the symbol. And the stock closed at $23.37. So probably the $25 straddle will be the closest to the money. Let's go ahead and buy that straddle. And we're going to do 10 contracts. Just for the sake of our being as thorough as possible, let's take a look at another strike price. This is the $25 strike price. Let's bring up the $27.50. That's a little bit more expensive. And we can go down to the $22.50. That's $2.35. It looks like, actually, the $22.50 is the cheapest straddle at $2.35. If we go down to the 20, it's a little bit more expensive. So let's go with the $22.50 at $2.35. Let's go ahead and analyze that as a duplicate trade. And we'll stretch this out so that we get the most recent August expiration so we can determine our range. We're going to use a $22.50 straddle for $2.35. Let's bring up our spreadsheet. Our at the money straddle is $2.35. That's the cheapest we can find. Our range of probability here is between 27.76 minus $19.47. That gives us a range of $8.29. and the current stock price is 23.37. And our volatility is 53.92%, which we need to translate into a decimal. So it's 0.5392. And then we'll just take a look at the chart and see if the historical volatility is considered low or high at this level, at this particular time. And it looks like, yeah, there's certainly a lot of volatility in this issue, and it seems to be to the mid to the high range. I would consider this to the mid to the high range, and it looks like it's going higher. So it's not in the low end of the range. It's certainly not in the middle end of the range. It's at the high end of the range. I'll just give that a judgment call. And then all we have to do is copy these over. I'm just clicking with my right mouse and then just dragging it over the cells that I want to fill in. And then I go to fill and down. Okay, now let's take a look at this a little bit closer. Now that we've done our analysis, we can kind of determine, actually, this helps us objectify the stock that we should be using for our gamma scalping activities. Let's take a look at each one based on its profit index. Netflix based on the profit index. Remember, we want the range to be as great as possible. In other words, we want this range compared to the stock price to be as large as possible. We want a large range with a stock price that's relatively small, because we want that stock to move as much as possible. When the stock moves, we make more money when we day trade using this particular technique. The cost index, basically what we want to do is measure the cost of the at-the-money straddle to the price of the stock divided by its implied volatility. If the volatility is actually high and we've got a relatively low stock price and a low at-the-money straddle, because at-the-money straddle is actually relatively cheap compared to the stock price. So that's relatively low. That's how we basically determine which of these issues we're going to be using for gamma trading. The profit index itself is simply a measurement of the ratio between the range and the cost. We want the range as high as possible. We want the cost as low as possible, and that gives us a profit index. Now, if we take a look at our profit index after all of the issues that we've put into our spreadsheet here, we notice that Netflix has the highest profit index, followed by American Express, followed by BRCM. On the low end of the scale, we have the Qs, which only has a 0.99 profit index. And at the very lowest end is our Clear Channel Communications profit index at 0.51. And it looks like the reason for that extremely low profit index is because of the range. The range here is extremely low. Even though the at-the-money straddle is only $1, the range in which they're predicting, the Thinkorswim platform is predicting its movement, is also extremely low.